Have you ever been scrolling through Instagram or YouTube and seen people flexing their stock market gains? And maybe you think for a second, am I missing something here? But here's the thing, what they don't show you is the full picture. Sure, I advocate for investing in the stock market, but only a small amount of my money actually goes in the stock market. Because the stock market alone will likely not make you rich, unless you're in it for the long game. And here's the deal, stocks can be great for some people. Stick around to the end and I'll explain what I mean. So the stock market on average returns about 7 to 10% each year over the long run. That means if you invest $10,000 today and get an 8% return, in 10 years you'll have about $21,500. Nice, but is it life-changing? Not really. Let's say you get a little more aggressive and invest $500 a month into an S&P 500 index fund. In 20 years, you'll have around $275,000. In 30 years, you'll have about $600,000. In 40 years, it'll be $1.3 million. Now, if your goal is to retire at 65, great. But if you want financial freedom now, not when you're old and gray, then the stock market likely isn't enough. And honestly, most people don't stay invested long enough to see those big returns. They panic and sell when the market dips. They try to time the market and end up making way less than those nice rosy projections. Check out this graph, the JP Morgan Guide of the Markets. Every financial advisor on the planet is probably familiar with this because anyone licensed typically gets this in the mail from JP Morgan. And for years, the data looks pretty much the same. The average investor is around probably under 3%. In terms of average rate of return, because they're doing things like we say. There's an old adage that it's time in the market, not timing the market. Hopefully that lands. And don't get me wrong, there's a surefire way to set it and forget it with automation, which I can't shut up about. But these things take time. And I remember making silly mistakes like this when I invested in, if you're familiar with the thrift savings plan, they have like the G fund, the C fund, the S fund, the I fund. And I was international, is international. And I remember it going down in value and I was like, oh shit, I'm losing money, thus locking in my loss forever, and got roasted by some of my colleagues at the time. So yeah, we all make mistakes like that, but to get those really juicy returns, you need to be kind of setting it and forgetting it. Do you ever notice that oftentimes the largest promoters of investing in the stock market didn't actually build their wealth that way? Dave Ramsey, he built his wealth selling books and courses and created a huge business and an empire, and that's where he built his wealth. Robert Kiyosaki made millions in real estate investing, as well as education on real estate investing, but not really stocks. Even Warren Buffett, he's not exactly out here buying index funds, he's oftentimes buying whole businesses. So why do they push stocks so hard? Generally, it's pretty safe advice, the kind that won't get them sued. The reality is the stock market is a great place to park your wealth, not necessarily to grow it. And I'm probably going to get a lot of hate in the comments for this. But you don't see entrepreneurs, real estate investors, and CEOs throwing all their money into index funds. They build businesses and invest in assets they control, and they focus on high return opportunities. That's exactly why stocks are not my main wealth building strategy. So if I'm not throwing my money into stocks, where am I putting it? I invest in this business that you're watching right now. Right now, for every dollar I put into ads, I get like $2 and change back on cash collected every time I bring on a new client. The return on ad spend is closer to 7 by the time they complete my entire program. So at minimum, that's over 200% return. The stock market's probably not gonna get that for you. And this has been awkward for me because I'm a personal finance guy and it's not like I don't like investing in index funds, but right now for me to grow my business, my giant drive is to help as many people as I possibly can. And so putting money into Facebook ads is the best rate of return I can possibly get right now. And that is the lead domino that helps me accomplish everything else in my life, quite frankly. By investing more in ads, I have more sales calls that book, I get to see more clients, I get to grow my business. I also invest in skills that make me more money. Stocks don't make you richer, they make companies richer. You know what makes you richer is skills. Learning how to sell, learning how to market, learning how to lead teams, automating my finances will help me achieve those goals forever. So early on, this was controversial, but I remember Alex Hormozy says invest in the S&P 500. And he went on to elaborate maybe in another piece of content that every day that you're not making $1 million a year is you have this like $1 million of ignorance deficit, if that makes sense. He would go on to argue that for $10,000, you can learn the skills to make $1 million. You know, maybe it's not going to make it for you instantly, but like you can understand the path to get there. And so I found that true for myself and my business, and learn learning how to sell, learning how to create a website, learning how to write email copy, learning how to create short form and long form content on these platforms that you're watching me on right now. Those are the skills that are helping me reach my message, grow my business. And skills that long after this business is gone, if it is, then I can still use those in many other areas. And I keep cash available for high ROI opportunities. So instead of locking all my money in stocks, I keep some available for, high return moves, whether that's my wife's real estate business, expanding my own business, or grabbing a rare opportunity. Because often when an opportunity comes up, you need to move quickly, not wait 20 years for the S&P 500 to grow. This is so true for me in my business right now because I'm on, maybe you've heard me say this before, like my fifth coach, which happens to be an agency, and they're helping me run my Facebook ads. They're helping me with like landing page tech issues and like my online funnels and all that stuff so that I can focus on this, so that I can focus on coaching. And every time I invest in the next coach, my business grows to the next level. So for me, it's a no-brainer. And yeah, absolutely, I want to continue to invest in the stock market. But for right now, this is my main focus. You know what no one talks about? The stock market might look like a guaranteed way to build wealth, but most investors never see those average returns, like we showed you in the graph earlier. Because again, the way that people actually invest is very different from how they invest on the chart. Here's what happens in real life. Most investors react emotionally. You're watching CNBC and Jim Cramer squawking about something, a market crash, and you react. You panic sell at the worst time, locking in losses instead of gains. Think about 2008 if you're old enough to remember that. I have a personal family member that told me at the kitchen table that he sold all his portfolio at the bottom of the market. That was probably decades of wealth gone overnight from one move. Most people don't invest enough to make a difference. We've talked in the past on this channel about how the average savings rate in America is like 3.7%. So if you're only putting a few $100s away a month, the returns won't change your life anytime soon, unless you are consistent over decades, which frankly, a 401k can be great for. We've talked about the automation component of that many times. Ultimately, you're at the mercy of forces that you cannot control. The market goes up, great. The market tanks, not so great. And you have zero control over when that happens next. That's one of the biggest problems, is that your wealth is in someone else's hands. That's exactly why I don't rely on stocks as my primary investment strategy. I want to put my money where I can have control and flexibility and a much faster return. Now, I mentioned at the beginning of the video that stocks can be great for certain people. And I think if you have a 9-to-5 that you love and they have a matching 401k, like great. If you want to live your best life and dial in your finances and you have no intention of like building a business or investing in real estate or things like that, then by all means, the biggest advice I can give is make sure that you are constantly checking in on your savings rate. There's a little function on the 401k where you can, instead of doing 6% to get the match, next year you can do 7 and 8%. The automatic increase is like the biggest sleeper life hack on planet Earth if your goal is to continue to invest in your 401k. So again, if you are locked in on the 9-to-5, you have all my respect. And frankly, I wish that most of that, like there are some days that I wish I just had like a great 9-to-5 that I loved, because building a business requires a lot. It's Saturday, my family is out and about, and I'm recording a video because I couldn't fit this in during the rest of my week. So pros and cons for everything. And sometimes it's just really nice to have a great secure job that you can just set it and forget it and cruise. So nothing wrong with that. Before we wrap up, I just want to say, never just flip a coin and blindly follow one strategy. There's more than one way to build wealth. For me, investing in this business and its growth makes way more sense at this time in my life than just investing in index funds. And that's my choice and not financial advice. Now, if you want to see exactly how I help people save thousands while building a stable financial system, check out this video where my friend and client Dan talks about how he saved over $200,000 by dialing in his systems with automation. Thanks for watching.